Hello, everyone. Welcome back to the Rational Investor School for Trader Development. Here we are in our Level 2 program. Slowly working through lots of fun candy for you guys to help build your trade setups, your trading plans, give you more tools to continually add to your tool belt. And here we are in now we are working our way all the way down to class 4, gaps and gap theory. And today is our group tutorial session. It must be 11 o'clock on the West Coast. It is. And just a quick heads up for you guys. Everybody should make notes. I will just post it here just so that you have it. How am I going to do this? I guess we'll go over here. We officially changed the clocks here in Vancouver on Sunday, November 4th. So that means that our next class is probably going to be at slightly a different time for you locally. So just make sure that you have all your ducks lined up, and next class, like I said, which is going to be a volume profile on the 10th, will be slightly different time wherever you are in the world. But anyway, welcome back to class. And I see we have a pretty full lounge here, quite a few people on YouTube. So welcome everybody. Today is our tutorial session, and James and I were just reviewing the questions for this session. No doubt about it, you guys are going to be making I'm going to be working my butt off here. We technically have 2 hours to do this tutorial, and I find that after a couple hours my voice starts giving out and stuff. And we also did the daily brief this morning, so I end up running out of steam after a couple hours. So with that said, James and I went and sort of did the math. I think we have the better part of about 30 questions here that we have to try and muscle our way through here. So 33 now. James has actually got a stopwatch going. And after roughly about 3 or 4 minutes per question, he's going to just give me a gentle reminder that I got to move on. We have so many questions, it's not even funny. Hopefully some of them I can answer relatively quickly, but maybe what we'll just make a note that if I didn't answer the question completely by the time that 4-minute mark hits, then I'll just see if I can write up some sort of answer in the Q&A document, and we can always talk about it more later on. But you guys have asked a lot of questions here, so I got to get off my butt and get rocking and rolling here. So it's 5 minutes past the top of the hour. James, you got the stopwatch ready to go? Here we go. All right, he does. All right, so question 1. How far back are gaps valid? The size of the gap matters. For example, what if there's a large weekly gap from 1998? Is there a value to more recent gaps, and if so, how much more value? Well, the irony of it all is that there can be price gaps going way, 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 way back, and we used to joke back in the 90s. I used to work with guys who used to trade gold back in the 60s and 70s. And remember, gold started, the last pegging, it was pegged at $32 an ounce during FTR's days. And then Nixon, of course, in 71, we all remember from the level 1 course, took the US dollar off the gold standard. And the gold market went crazy. And we used to joke that one of my broker buddies, he used to say, I still have a client who's got a bid working at $200 an ounce gold. And he's waiting patiently for that bid to be that gap on the gold chart to be filled in. So as you can clearly tell, looking at a gold price now, we're nowhere near that. And we never did fill in that gap at $200. And it's still technically open out there. So the long and short of it here is gaps can remain open, especially if it's a big asset like gold, can remain open for very, very long periods of time. Would I consider it a relevant level? Absolutely. If the gold market does fall out of bed, and let's say, I don't know, maybe we switch to Bitcoin as our currency proxy and leave this whole fiat world, maybe there won't be any demand for gold going forward. Who knows? And as a result, the gold price will work its way down. If I saw that the gold price was trending lower and I wanted to try and think about downside targets where it might ultimately stop going down, I would then pull up that chart. And actually, I've got it. I've got literally the paper version of that chart around here somewhere. Maybe I'll try and find it and take a picture of it for you, showing those gaps at about $150, $200. So I would definitely keep it in the back of my mind. Now, obviously, with the market trading here at 12, 1300, whatever it is, that number isn't relevant today. But those gaps would, as a technician, in my eyes, still be very relevant going forward. It's just a question of, is the market trending in that direction, and can we use that as a price objective? So you say that there was a large weekly gap from 1998. It's interesting, of course, that was basically the last pivot fear greed cycle. And actually, I was just talking about Rafa Camporo made a horrible stock market call. 1998 was right around long-term capital management issues as well. So actually, I remember that market very well. It'd be interesting to see what asset it is you're looking at. But yeah, I would definitely have it in the back of my mind. Would I use it as a target for today? No. But if the market started trending in earnest, could I use that as sort of like, well, if all hell breaks loose, this is probably a level it could go to? Absolutely. I hope that helps answer that question. Obviously, more recent gapping action means it's something that happened relatively recently, a confusion, indecision in the marketplace. So, I would put it into context. If it happened recently, are you using that gap as a projection tool, right? And of course, I had lots of fun with gap theory. And gap and go, Joby gaps, right? Doji gap setup, all that kind of stuff. If it's relatively recent and you're using it as a projection tool, obviously it's pretty important. Then if the trend reverses and you're trying to figure out where the market might come back down, obviously those gaps in the short term are totally relevant. What's really interesting is if you pull up like an hourly chart of Bitcoin. And actually I did that recently off of, I think it was Stamp. And, we've all been talking about how Bitcoin's sort of trapped in a trading range. Where the hell is it? It's around here. I think this is it. We were watching Bitcoin here just off of the hourly chart. How relevant were these price gaps? Well, they were pretty darn relevant. And you notice that most of them basically got filled in. So, I would definitely say that off of the shorter time frame, they're important. And, especially something like a crypto that trades 24/7, if you see them off of the hourly basis, then it means probably the market's going to have to come back in the short term, probably off of like a lower time frame. In fact, this is even a 15-minute chart. It's probably going to have to come back and fill these in at some point. And it's interesting, too. You could make the argument that this is sort of gap and go. So it's going to have to sort of finish its projection move. Then once it finishes its projection move, maybe into another gap, then it'll slowly work its way back up and fill in the gap. Okay, I hope that helps answer that question. Very good question. Totally valid. Okay, so I don't know. Thank you for posting there, James. I think you're going to have to just take yourself off of mute and go, beep or something, because if I've got a different chart up, I'm gonna be totally lost. But anyway, all good. Looks like we're heading in a good direction here. That's the most important thing. Okay, number 2, cause stop loss. Cause stop loss, take profit levels. Oh, maybe because stop loss take profit levels get skipped by gaps? Okay. Is it right to say that these levels the chart likes to bounce because the orders get fired later? Um, it's not a bad way of thinking about it. Actually, yeah, I think I would generally agree with that conversation. Going back to our short-term Bitcoin chart, right? Market failed through here. Maybe had someone had their stop loss order in here, and in this case, they actually blasted it through all the way through here. That stop loss order definitely, would get filled. And ironically enough, probably a lot of what this is was sort of market orders. So as a result, the price goes absolutely nuts on the event of the filling in the gap because all those old orders are still sitting there waiting to be filled. So that's not a bad way of looking at it. Here you can see market tanked into this level. If you were, I don't know, maybe like, I'm not quite sure how you would express that. Let's see if we can find a better example for you. Maybe you were short here. The market came up here. Mind you, that wouldn't be that good of an example. That's tough. I'd have to find, I'd really like for you to show me a chart of what it is you're looking at here. But on balance, that statement sounds basically correct. Number 3, but I saw that gap levels, even if they are filled, are still interesting levels in the future. Is that right? Well, what you often find happen, kind of like our little stamp example, is that there's obviously something, and kind of like what we'll maybe talk about with gap theory, is what you want to see is sort of confluence, right? So the fact that this is a reload zone, it shouldn't surprise us that there's a gap in there that's going to sort of, this will be supply that will hit the market. Because a lot of guys will actually just simply use the gap levels to work their orders. Maybe here's a good example where maybe a guy wanted to get stopped out. The market gap lower, it moved away, it never came back down, and it started to really tank. And the guy's sitting there going, well, I had my stop working here. I'm just going to leave it and let the market work its way back up. It turns out it's a reload zone. And so on this big burst, boom, he gets filled here. But what I really would like for you to sort of take away from gaps, and, I mean, we might as well ask everybody, how many reasons should you have to take a trade? Should it just be gaps alone? Anyone? Yeah. So what I really want to hear from you guys and see from you guys is, oh, I absolutely love when gaps happen to be in reload zones. And then, next module we'll do volume profile. And what you're going to see is volume profile and gaps, they coincide quite a bit. In essence, there was no real sort of buying or selling at that level. And so as a result, there's a notch in the profile. So what should end up happening here, and this is kind of like this Gold Corp chart I put out, I actually, through the week, I got some really interesting feedback from one student who is kind of like, I need more, Brian, I need more. So I actually went and found a whole bunch of additional gap resources for you guys to chew on. Really good article here from Futures Magazine on gap theory. And it turns out that gap theory was written by this Gartley guy. I don't know whether you guys have ever heard of Gartley. So, we're just sitting here, how to spot trends in commodities, all that kind of talk, right? They're not going to specifically make reference to Mr. Gartley, but it turns out that this is basically Mr. Gartley's theory, wherever the hell it is here, this image here. Yeah, the Gartley, of course, the harmonics, right? But hopefully everybody sees this image. But the point that I'm trying to make here is that what should end up happening is, can you see how we have this big rally from this low straight up to here, and then we consolidate, and then we break out higher. So your level one course material would say, well, we should probably be doing like fib extensions off of this range if it decides to resolve higher. And so thinking parking garage, 1.618 to 200%, that's kind of where we would expect significant resistance to come in. And what I need for you to be able to take away from this is, what a coincidence. In this particular case, we're using gaps as projection targets. Those targets happen to line up with fibs. And we also have a gap theory move down. In this particular case, the gap theory projection targets line up with reload zones. So my simple answer to this question is, gaps are awesome trading tools. What I really want us here is the gap lines up with horizontal support and resistance, which you've done now, maybe lines up with moving averages, lines up with fibs, and you get sort of validation of a level. That's the key. Thank you, sir. Good. That worked well. Excellent. Well done, James. So I'll try and I think I talked about that. I did a good job on that answer, right? What do you think? Does that sound about right? Does that sound about right? I don't know whether you can answer that or not, but I think I answered the question. All right, Brina. All right, James now affectionately calls me Brina. You're awesome, James. James fucking, and like I said it, and I did it in the daily brief, and I do it awesome. I am so privileged to be hanging out with all you people. You're such good people. It's fucking awesome. All right, let's keep moving forward. Does the feed that you get information from determine gaps? Does the feed that you get information from determine gaps? For example, what is BATS data compared to other feeds? Ooh, okay, that's a good question. Long and short of it here is, BATS is what they call an ECN, or Electronic Communications Network. Let's say 30, 40 years ago, there really was only one show in town. It was the major exchanges: New York Stock Exchange, right? American Stock Exchange, NASDAQ Stock Exchange. And you had to get your information from them. Then in the 1990s, especially with the advent of the internet, we had a whole bunch of regional exchanges all start to produce data feeds, and they sort of wanted to sort of monetize them. So they created these things called electronic communication networks. ECNs. And what's ironic, and this is almost exactly how business always seems to go, is over the past 10, 20 years, slowly all those ECNs, you guys probably have heard of, like Archipelago. That's a really good one, really good example of an ECN. There was tons of them. But in essence, one by one, slowly, all of these ECNs got gobbled up by and New York Stock Exchange, Amex, NASDAQ, Euronext, all that. And they've sort of become part of, kind of under the umbrella of these major exchanges. And the number one reason why is because people pay money for real-time data information. So these data feeds are actually just total cash generators for these exchanges. They make a lot of money off of this information. BATS is a recently newly created ECN, and a site like TradingView can get the ECN data for the various different instruments. And because BATS is relatively new, they're giving their information away for free right now, which of course pisses off NYSE, NASDAQ, Amex, Euronext, pisses all those guys off to no end. And my hunch is, at some point in the not too distant future, one of those big exchanges is going to come along and gobble up BATS. as it stands right at the present, it's a good way for us to get free, data on these exchange traded instruments. So take advantage of it while it lasts. But my hunch is probably 5 years from now, bats will be gone. Is the data complete? And I don't think the answer is yes. I think the answer is no. Remember, we talked a little bit about be careful with exchange traded issues like ETFs and stuff like that, because, especially remember we showed you the ETF on silver. I mean, it just looks like a Swiss cheese on these major exchanges because silver trades 24/7 and the exchanges are open only a certain amount of time. I might make the argument that the BATS exchange data is also a little bit splotchy in that regard. So very good question, excellent question. And it just shows that you're paying attention. And the simple answer is yes, BATS data is going to be more splotchy. It's going to have more gaps. And, the easy solution whenever I'm working with, say, Sjord and we're trying to compare data is I always just pop on over to stockcharts.com, especially if if it's a stock market related issue. And I'll just pull up, say here, for example, this is the S&P 500 chart. And it is the NYSE plus BATS combined. So then that way the charts aren't nearly as splotchy. And I would highly recommend, if you are interested in stock market information, to go to a third-party site like that if you happen to see lots of gaps, just to verify that the NYSE or NASDAQ data or whatever isn't corrupted if we look at the BATS chart on TradingView. So a very good question. Excellent, excellent question. All right, there's the alarm clock. Next question. Is there any way to protect yourself from gaps when you have a stop loss order in? Nope. Welcome to the vulgarities of trading. And as we sort of said in prior sessions, sometimes the market will actually gap beyond your order, and you're basically trapped in the position. And the irony of it all is that none of you guys have ever even seen a fast market. You guys ever heard of the expression fast market? There was back in the late 1970s when there was worry about hyperinflation. You used to have commodity markets would actually be locked limit moves. So whoever's typing here, let's put a little side note assignment. Maybe I'll even do that here. Maybe 1970s. I think it's a good idea for everybody in here to, we'll do a bracket, Brian's side assignment. Look up, say, like a silver chart from 1979 and check out fast market conditions. This would be a really good sort of side assignment if you want to do a little bit more work on this, in that this market was quote unquote locked limit. All right, why don't we even put that in here? We'll say locked limit, and soybeans also. Silver, we'll do soybeans, where quite literally for like a week or two, every single day, the market would open up locked limit. So in essence, it would jump like 30 or 40 cents. And then that would be the limit that the market was allowed to move. So instantly it would close. So you're screwed. If you're trapped in a position and the market's locked limit, there's nothing you can do. I mean, you're locked out of the market, and the market can just keep gapping day after day after day after day. So, as a really good lesson for all of you guys, do yourself a favor and go look. And it looks like Joshua's even put in here lock limit, and go and just do some work on this condition called fast market. And there is a whole bunch of strategies on how to deal with if you have a position on and the market is lock limit. In that very brief window where the market is open, it'll be open for maybe like 10, 15 minutes. You can go and buy if you're long, or let's say you're short and the market's lock limit higher, you can quickly go and buy a put option on that 10, 15 minutes on a deferred contract. And then that way, at least you've got some insurance on so you can cover your ass if the damn market just keeps lock limiting higher day after day after day. But the long and short of it here is no. Welcome to the vulgarities of trading. And if anything, none of you want to see a fast market. You should all be going, okay, I'll learn about this fast market condition, but please, God, don't let me be caught in a fast market. All right, that is a good question. How are we doing on time? Did I go over again, James? Sorry, trying to. Uh-oh. Okay, good. All right, number 6. What is the minimum gap size to name it a gap? Well, I suppose more than 2 pennies, right? 2 ticks. 1 tick, it would just be the last bar would be slightly, I suppose even 1 tick, right? I mean, technically, if the market ticks one tick higher on the next trade following the previous candle, and this also gets into whether it's a candle gap or a bar chart gap. Bar chart gaps, obviously, you have to clear right through the previous candle's high or low to make sure that it is an actual gap. But technically, it could be as small as 1 penny. And kind of like what we showed you on that Bitcoin chart, I mean, these gaps are all over the place, and some of them aren't very big. So technically, really, it could be as small as a penny. You have to be careful here, though, whoever asked this question, what type of gap? 1 sat, sorry. Joshua, thank you for correcting me. Could be. Mind you, 1 sat's pretty expensive these days. How much is 1 sat? Somebody do the math, quickly find out what 1 sat is worth. But you have to be careful here in making sure that you've identified the different type of gap, right? Because common gaps happen all over the place, right? Like here's a common gap, right? And these kind of, I would actually argue that, off of our Bitcoin 15-minute chart, these would, to all intents and purposes, be common gaps where they're just basically filled in. Breakaway gap, measuring gap, exhaustion gap. Technically, they all could be just 1 tick or 1 sat or whatever term you want to use. But simply put, I think it's probably more important for you to understand the context of how the gap is happening and why, right? Is the market actually breaking out of a trading range with the price gap? That's important. Right? Versus just a common gap where, the market quickly fills it back in. Number 7, does the size of the gap mean anything? Is larger more powerful? Well, what trade setup do we use to help us trade the gaps in the short term? Is there a setup that we use that we're going to trade short term? Joby gap. All right, that's a good one. Doji gap, right? Gap and go. Obviously, if you have a gap that's like 10 miles wide, the market opens up and then ticks up through the high. Well, technically, we should expect another 10 miles on the other side of that. If it's only 1 tick, the market gaps higher that 1 tick and then moves through the high, well, your target's only 1 tick higher. So does the size of the gap mean anything? Absolutely. It can basically determine how big the continuation move is, and try and think of gap moves as like that AB equals CD kind of concept. So the gap itself is the AB, Should be a little bit of a consolidation. If we go through the gapping bars high after the consolidation, that's your CD leg. The bigger the gap, the bigger the CD leg. Hopefully that helps answer that question. Brian, would it make sense that a market with lower fees and higher trading volumes, liquidity, okay, Coinbase will have significantly less gaps, thus they will be more meaningful? The first part of this statement, absolutely. You know, like one sort of side assignment that in class I think I briefly mentioned to you was go and look at like a very liquid market trading and then go and pull up like a Cryptopia or a maybe Binance to a certain degree, but maybe like Polo, where there just isn't that much trading, and you will almost guaranteed see gaps all over the place because the market is relatively illiquid. So what I actually like to do is just let the liquid market trade, then go and look over at the illiquid market. And that will often, if there are big gaps there, that will often be a great sort of tell. Like you look at the big liquid market, there's no gaps. You go look at the illiquid market and you see, oh, gee whiz, there's a big gap there. Well, odds are the big liquid market will come back down, even though there's no gap there, but it will work its way back down to fill in the gap off of the illiquid market. And actually, we saw a really good example of that on the Canadian dollar, where the big CME futures contract did not leave a gap when the Bank of Canada raised interest rates. But I pulled up the micro contract, and it had a monstrous gap where that breakout occurred. And as a result, the market had to work its way back down and fill in the gap off of the micro chart. And of course, the micro markets are much less liquid than the big contracts. So another excellent question. Absolutely right. I would actually say it's the other way around, though. I would say that use the illiquid markets gaps as sort of your levels to be hunting off of the liquid markets that don't have gaps. Number 9. So if there's a gap on the daily, is it mostly filled on the 4 or 1 hour chart? That is not a valid fill, right? Well, what may happen is the market comes down and off this 4 hour, 1 hour chart fills in the daily gap. But if the market fills it in off of the 4 hour, 1 hour chart and then reverses, then what that will create is a tail or a wick on the daily chart. And our old rule, of course, is that for the gaps to be filled in off the higher time frames, we want, well, the gaps to be filled in anyway, we want candle bodies. So as a result, if we get the gap fill off the 4 hour, 1 hour, but we've left a tail or a wick off of the daily, then what that tells me is we're probably going to have to come back and do some more business down at that level. Hopefully that helps answer that question. Great question. Very good question. Joby Gap setup. We will be back. Okay. Number 10. And how you doing, Mr. Typer? Mr. or Miss Typer. I'm not even quite sure who it is. Looks like they're kicking ass here. Maybe I'll slow down. How are we doing on the stopwatch, James? Are we ahead of schedule? I just don't really want to fall behind. That's all. Doing good. All right. Thanks, man. Okay. Number 10. Continuation question to 9. Okay. If there is a gap on the 1 hour, 4 hour, and there is no gap on the daily, the gaps are still valid. Sure. Absolutely. But I would say, how do we say this? There's probably less sort of magnetic pull, if you will, on the market. A higher time frame gap is going to have more of a magnetic pull. So if the daily chart is clean, but you pull up the hour, 4-hour chart and you see gaps, those are probably going to be continuation trade gaps. And eventually, when the daily chart ultimately either tops out or bottoms out and starts moving back, then we can use those hour, 4-hour gaps as reference points for levels going forward. But obviously, a gap off a higher time frame is going to carry more weight. Good question. Steve Neeson says that gaps he calls windows. And keep in mind, Steve Neeson is primarily working off of candlestick charts. All right, he's Mr. Candlestick expert. He calls windows only occur when price does not overlap at all. Wicks, tails included cannot touch each other or candle body. Okay. And so in essence, that's our classic bar chart gap, right? And create fairly strong support resistance areas. Why do the Japanese only consider these types of gaps significant? Well, as we said before, the classic North American sort of use of gaps and gap theory is based off of bar charts, which would in essence be the same as this. So I don't think that the Japanese only consider these types of gaps significant. I would actually say that's the classic interpretation of gaps. So I wouldn't say the Japanese only maybe the Japanese do, but I would say all, regardless of whether it's candlesticks or regardless of whether it's bar charts, the gaps that actually have air between the highs and lows are far more significant as sort of like holes on the chart. And really what we need to do is, whoever asked this question, I want you to remember this question when we go through the volume profile module. Because when we actually talk about volume profile and the importance of the price discovery process, then you'll understand that candle gaps, technically there has been price discovery through those zones. Whereas if we have clean open air between the candles or the bars, that represents an area that just has had no price discovery. So this question, I would actually say dovetails really nicely with the next module that we're going to work on. And really, the simple answer to this is it's all about the quote-unquote price discovery process. So, Mr. Typer, I actually want to take a pause there so that you could write that down. It's all about the quote-unquote price discovery process. Excellent. Beautiful. Well said. Okay, number 12. Can we go over the difference between a breakaway and measuring gap again? Okay, well, the key with a breakaway, and it's really simple, right? And that's why I really like this chart. This is why I really like this, because it's nice and clean. It's nice and simple. Remember I was saying earlier about fast markets? Can you see how, like, through this period here, the market went through a fast market? It's gap, 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 gap. If you were short through here, say you shorted this against this high here, or maybe you had like a railroad tracks, can you see that this like week period, you were just dying 1,000 deaths, right? But to answer your question in particular, right, the difference between breakaway and measuring, very simply put, the breakaway gap should take price out of a trading range. And whoever asked this question, hopefully you can see that this is in essence a trading range. The market gapped higher and it just didn't look back. After the gap, we cleared through the top of the range, and you could even just draw a simple trend line off of that peak and here, and you can clearly see that the market is gapping higher and it's leaving this range. That's the whole point of this concept called breakaway. is in essence, it is leaving the trading range. Now, the issue with the measuring gap is that we've got clear evidence that the market is trending in one direction. The question ultimately is, how big is this move going to be? That's really what this all comes down to. And it turns out that these measuring gaps usually come in at about 40 some odd percent of the ultimate move. And if we think about, again, think of that AB equals CD kind of concept, you could make the argument that this is an AB. And if we hold this gap, then that's CD. And in essence, that's basically just the midpoint of the move. So the big difference here is, like, in this Gold Corp chart that I showed you guys, really we had a ranging market here, right? And you can see the downtrend, and the market gapped violently out of that range and didn't look back. So that's why I like to call this a breakaway gap. Very similar to what this is. The market gapped higher and just didn't look back. Okay, so very good question. Excellent question. The long and short of it here, breakaway means we're leaving a trading range. And it will be very evident on your charts. You will look at the breakout and you'll go, holy shit, did that thing ever take off out of the trading range? This isn't necessarily like you're going to be hunting a trade setup through this. If anything, you're going to see the breakaway. Then you're going to see, holy shit, this thing just keeps gapping higher. What the fuck? So then you're going to say, okay, well, we got the breakaway. It's clearly obvious we left the range. And now we're gapping higher again. And again, also too, I really like this kind of conversation where this gap here, they like this because it's just open air here. But in essence, this gap has happened, and now you're kind of like, okay, where the heck is this market planning on going? And what should be cool is if we actually zoomed out on this, we should have like extension targets and stuff that are all painting targets up in this area. And what you really want to do with the gap theory is just say, okay, if I subtract the measuring gap from the breakaway gap and then just simply add that to the top, does that give me an upside objective? And in essence, that's basically what this is, right? There minus there plus there gives us that upside objective. Now, if you want, okay, did you hear that? I just said, and now and I was going to go into a whole new spiel, but we hit the time limit. So if anything, I'm going to leave that question at that. Thank you, James, keeping me on time here. Number 13, since the BTC altcoin markets are 24 hours, does this make gaps on higher time frames more significant? Frankly speaking, you just don't see gaps on higher time frames that often because of this fact. I mean, and if we do see price gaps on these charts, they become hugely significant. So, less significant or more significant? The answer is more significant. The why? Well, it's because these markets should be extremely fluid because they're trading 24/7. So we don't have any sort of references to exchange closings. It definitely has something to do with short-term, either demand or supply just overwhelming the market. And the sad thing for things like Bitcoin is we still have some gaps in the 3,000-4,000 area that just haven't been resolved yet. My hunch is at some point over the next 15 years, those gaps will be resolved. Is it today or tomorrow? You don't know for certain, but there's definitely a lot of unfinished business down below there. Okay, hopefully that helps answer that question. Very good question, very articulate, very poignant. And the simple answer is, especially on things like altcoins, when you get a gap on a higher time frame chart on an altcoin, I can almost guarantee you that once this sort of initial move is over, the market will come back down and fill that in. I've seen that. And usually, like Joshua, our resident demon gap hunter, we love using these gap levels as sort of, okay, now that the market has officially seasonally topped, and we're now starting to think about buying back the shit that we sold up top, where are some levels for us to start thinking about working bids? And it works fantastic. I would definitely say with regard to things like venture cap, right? I might even say here in regards to VC, and then that statement. Okay, regarding gap theory, do the measuring gaps generally occur during the consolidation phase? Well, technically, they should happen following the consolidation phase, kind of like our Gold Corp here, where you can see we had an initial burst higher, we had our breakaway gap, then we had to have a consolidation period. It's after the consolidation period is done, then the measuring gap will kick in. So here, for example, and this really wasn't much of one, but we had a big move up, and then we had this consolidation period. Then the market gaps violently higher. Now, the interesting thing about this measuring gap they have here is if the market had come back down and actually filled this gap in, then that would have negated this as a measuring gap. I might argue, and kind of like what we saw in that little uranium stock that we bought recently. Let's see if I can find it here for you. I think it was over here. Oh. Do I not? Oh, wait a minute. Maybe I have it over here. Yeah, here we are. Now, you can see measuring gap, exhaustion gap, and they're not really huge. Don't get me wrong. I'm not going to say this is monstrous, but I think it worked pretty well identifying upside objectives. You can argue that this whole gap issue now has been resolved. Why? Because the market has come back down, filled in the measuring gap, filled in the exhaustion gap, and look at the reaction following that event. So my hunch here is, yeah, the market gave you a short-term objective. And then, we could probably do silly things like 50% rules. Oh, gee whiz. So very natural, healthy technical correction that comes and cleans all these gaps up. And now we can start the next one. In fact, we might even, right, if this market, we're going to do this. If this market gaps higher here, just hypothetically, right, we might even actually be thinking about this as the newest measuring gap. Breakaway gap, trying to leave the range. You might argue that that is a common gap, but I like this as a breakaway gap. Market comes down, fills in the measuring gap, fills in the exhaustion gap, and now we might actually be setting up this as the next gap theory setup. And the interesting thing is, right, if we applied like fib extensions, right, I know there's lots of people in the market that would look at this and say, okay, well, if we do break out through this high, then odds are we got to head up into this extension zone. Right? If we do gap like this, I don't know if it's going to happen like this, but just hypothetically, well, then we'd be boobity boo, right? And then project that off of the high, giving us a target up into here. And what we should see happen when we get up top there is the exhaustion gap comes in somewhere like up here. And that basically is foreshadowing that we're just basically done the move, kind of like what we saw through here. Hopefully that helps answer that question. Great question. What do you think? Did I answer that question? I think I did. The measured gap should happen not during, but following the consolidation. Okay, yeah, you wrote following here. Awesome. Time. All right, move on. Number 15. Regarding large gaps. When you use a large gap as a target, do you target the bottom or top of the gap as your objective? Well, both. And you're like, well, that's not an answer. Come on. So I would argue that this level right here, hugely significant, because if so much, and there's also this gap down here too, right? But if there's so much pressure on the sell side that the market cannot enter the gap, then that in itself is actually extremely valuable information. Remember, we said that, if you actually took this chart and you did a fib off of this low back up to the gap level, what we should see happen is reload zone probably lines up somewhere in here. And this is kind of cool too, because notice that's 38.2. So if we rally up into here and we can't, I would definitely use that as a resistance level, and you can draw your fib off of that level because this is in essence a trading range. And if we can't get even back up to the gap, then that is a huge tell about the technical health of this issue. If, however, we can get back up and actually fill in the gap, then that is a positive about going forward on this asset. So that's actually a real subtlety that I've only learned over time. But really what I want you to take away from this is you really want to watch, we're going to use the gap as a target, and we're going to watch how the market acts heading into this level. If we find that the market rallies up and puts in a fractal or an M top just underneath it, well, see you later. I'd be more than happy to. But remember how we will set that L tangonator up, right? If we come in W here and there's nice divergence and stuff, and we're going to take the trade, what we should do is break this into quadrants, right? No, that's okay, Rohan. I don't want to spend too much time on any one particular question, but what I'm just simply saying here, and it's like all of these, right? You see them all over the place. We go boobity boom, and boom. All right, so on the entire range, gee whiz, 38.2 is right there. So I would actually be using this if I was, and I suppose, geez, how far? Wow, look at this thing. It's just cratered, eh? Really, I think 38.2 is right there. If we were doing, say, a lower time frame trade setup, I suppose I could use this as a trading range. So there's 50% level. I actually would expect that the market's going to work its way back up here. We did the horizontal support and resistance, and just keep me honest here, James, with time, okay? But I would actually expect, and notice, do you see, Rohan? There's actually a cheeky little gap right there too, eh? See that? So I would actually expect off the higher time frame. And then if we draw a trend line, remember I said earlier, I want you guys thinking about confluence, right? I want you thinking about, okay, am I going to take a trade just off of one reason? No, I want to have a whole bunch of reasons to consider risking my hard-earned money. So I might actually make an argument that really I like a rally up into this area. And then, of course, if we think the reload zones, right, probably we should expect resistance to come in somewhere there. So there is the higher time frame, 38.2 right there. And then this is the reload zone off of the lower time frame. So the point here is if you happen to have gotten a L tangonator that's setting up off of lower time frames for your rally into the 50% rule, then what I'm thinking here is if 50% level is your target objective, and maybe you're going to play this W, I don't know. Going to risk against the bottom end of the range. Ideally, I can't take the trade unless I can realistically see a 2-to-1 risk reward. So at this, man, that's a marginal trade at best. If anything, what I'd like to see is the market come back down, put in an ace W, and then we'll hunt the trade off of there. But I would definitely be listening to the market's message. And so with regard to El Tangonator, what I wanted to originally say, and I really like this because it seems to be working extremely well, is I'm going to apply the bot trade metrics to the actual levels. And I'm just going to simply say, of course, it's backwards. I'm going to simply say, all right, I can go long here. If we get a move up to 50%, I'm going to move my stop to scratch. And if it pulls back, then I'll just walk away. If I get a move up into 66, then I'm going to start trailing stops. And does it make sense here, Ron, that if we rally up, come into the gap, but fail, cannot get into the gap, and I put in an M and I start breaking down, I'm going to get the hell out of the trade on this move stop to trailing, market structure failure there. Does that make sense? Thanks, Joshua. But I'm wondering if it makes sense to Rohan. Okay, cool. Awesome. But very good question. And I know we're over time. I apologize, James. But excellent question. You actually have to listen to the market. Remember, half of our job is just simply listening to the market's message. So whether the market can actually fill in the gap, whether it actually does fill in the gap, definitely this is an objective. It's definitely a technical target. But actually how the market acts as it's approaching this gap is incredibly valuable market information for us technicians to actually listen to the market's message. So very good question. And I'm glad actually we had this opportunity to talk about that because actually that's really cool. And maybe make a timestamp reference or something right there so that people can go back and watch that later. That is a really good question. Okay, number 16. How are we doing, James? You feeling good? I'm going to take a sip of beverage. Hang on a second. Okay, number 16. According to Japanese candlesticks theory, there's the belief that if a window gap doesn't close in 3 days, then the market shall rally away from the gap. Could be. Does that hold truth according to your research? Actually, you know what? I was even doing this for you guys earlier. I went on our buddy Blutowski. I always call him Blutowski. Does anybody know who Blutowski, the reference Blutowski is? Animal House, doo-doo, doo-doo. Animal House. Anyway, one of the characters' name I think is Blutowski. But if I, where the hell's the class page? Is this it? No, that's not it. Did I get rid of it? Oh, maybe oh yeah, I probably did it like this. Yeah, there we go. I included here Mr. Blutowski's work, and I always butcher his name. I'm sorry. Bulkowski. Bulkowski. Actually, I think he's a cousin of yours, isn't he, Raf? Sounds Polish. Yeah, that's what I was thinking. That's funny how Raf actually posted that. And actually, interestingly enough, he could be a cousin of yours, eh, Raf? I mean, so get a picture of Raf. Actually, they look very similar. Anyway, Mr. Bulkowski did a bunch of statistical studies on gaps, which I think is probably really good for your sort of notes. I'm talking about sort of here, area common gaps, 3 days for both breakouts directions, 136 days for upward, 168 for downward, 98 days for upward, 77 days for downwards, looking at all the different gaps and what are the statistical relevance and when do they get filled. So your question, unfortunately, is you're just saying gap. Really, the answer to this question is what type of gap is it? Obviously, a breakaway gap is going to carry very different implications than a exhaustion gap. And as I said just a moment ago, Mr. Bukowski did a whole bunch of work. Exhaustion gaps, we should expect them to be filled in. And that's sort of like our example of this Denison, right? Exhaustion gap, this thing did not stay open very long, but boom, boom, filled in, right? And that's what should happen. But breakaway gaps and measuring gaps, they can stay open for a long period of time. And if you want some help with sort of statistics around that, I would suggest you pop on over and check out Mr. Bukowski's work. So good answer, good question. You have a chart link. Let's see what you got here. Okay, this shadow would close the gap according to Japanese, but it ended up rallying up. This shadow, no, I would leave that. I would say that that's there's open air there. It looks like the tail of this candle tagged the peak of this wick. So yeah, I mean, I can understand that classic, and the way that I say it is classic bar charts would show no gap there. But the candlesticks, I have personally found that markets really, they don't like to leave these tails and wicks unaddressed. They do like to have candle bodies in them, and here's a really good example. Let's see what here. Gap not filled, down we go. Okay, so there's a gap up here, and really I would call this gap and go. If we lose these levels in here, and it did this day here, that actually is your trade signal right there. And sure enough, boom, down we go. The interesting thing is I'd be willing to bet dollars to donuts, though, that will at some point come back up and fill this in. And I don't know whether that low corresponds with that high there, but that might also be open air there too. Time. All right, keep moving on. So in summary, okay, so I suggested that you pop on over to Bukowski to check out those sort of number statistics. Me, Brian, I'm gonna want to see gaps filled in, and it's for a guy like me, it's not really a question of if, it's just a question of when. And as Mr. Bukowski sort of points out, there are sort of statistical durations, and then of course you have to ask yourself, what type of gap is it? Really important that you put the type of gap in context. Super, super important. Okay, number 17, more candlestick Japanese theory. They say the gap is created when the candle shadow extremes do not overlap, in your opinion. Does that define the most relevant kinds of gap, or according to your experience, the other kinds of gaps where shadows overlap equal weight, equal importance? I would say that an open air gap, what I would like to call a bar chart gap, I think it's more significant in the market's eyes. I find, for lack of a better term, I actually find that candlestick gaps are, I would actually call them trader gaps. Because keep in mind, the irony of it all is that not a lot of people in the world understand Japanese candlesticks. I mean, because we teach it in the level 1 program and you guys are extremely computer savvy and stuff, it's not really that new to you guys. But if I went out into the public and just asked 20 people on the street totally randomly, I would be surprised if one of them actually understood what Japanese candlesticks even were. So ironically enough, most people in the public, they don't even understand what one of these candlestick gaps are. I would call them trader gaps, because it's only the traders that really actually understand what the hell is going on there. And you often hear me say, wicks and tails like to be eaten, right? So as a result, I have personally found from a trading perspective that those gaps like to be filled in. But the irony of it all is that most people in the public really, I mean, and in the public, how many people do you think actually have read Mr. Neeson's work? I even know who the fuck Steve Neeson is. I would be willing to bet that if you went to Japan, not less than 2 or 3 people in 10 would actually understand what Japanese candlesticks are. You guys got to understand that you are very, very advanced. We sort of poo-poo it here, but the irony of it all is that not a lot of people understand what Japanese candlesticks are. Okay, number 18. I love the expression, quote unquote, closing the window, referring to filling the gaps. Okay. According to Japanese, this can be accomplished when candle shadow hits the gap. I mean, yes, it is right, but I don't consider tails and wicks to be fully filled in the price action. I see that at TRI, we prefer candle bodies to fill the gaps. Yeah, I do. Not just the shadow. I would love hearing your thoughts about this preference. Yeah, well, I just gave them to you. I just personally find that, like this up here, you could have like a wicked shooting star that will come up here and fill that in. And if the body comes back, I don't think it's done. And, if you're saying that there's a gap down here that was technically filled in by this price action and then the market reversed and left that open, then I got to say that at some point I got to expect the market to come back down here. And you guys all should look at this and go, oh, shit, I know Brian's going to totally say he loves trade location at the candle body lows. So if this was a gap from previous, then I love a stab into this tail, and I'll be a buyer right at those candle body lows. Absolutely. So I hope that helps answer that question. Japanese see gaps as a magnet that attract following corrections. Sure, sounds good. Somehow, unfilled gaps become support and resistance levels, and it would be possible to consider them as one of the reasons to enter long or short. Well, just make sure that you're using the setup in context. Would you agree that a significant gap could qualify as location reason? Sure, absolutely. But, do we ever take a trade off of just one reason alone? And the answer is no. Ideally, I'd love to see that the market rallies into the gap, puts in a nice structure, and the rally into the gap was on a divergence. And then go for it. You got gap, you got divergence in your momentum indicators, and you got structure. You want to take like a nice empire or something off of the gap fill? Fucking it. Ideally, as I've sort of shown you repeatedly even today, usually the gaps actually line up really, really nicely with horizontal support and resistance, with moving averages, with fib levels, and of course, most importantly, and it feels like this is the same person asking a few questions. Most importantly, next week when we do volume profile, right, then you're going to really see how incredibly powerful these gapping levels are. And there's a lot of guys in the pit that just trade nothing but volume profile. And when we put the two together, it should be like oh, fuck, now I see what's going on. Okay, this makes sense as an excellent trade location. Remember, this is going back to that price discovery process. Okay. Yeah. Okay. So you got, yeah. So as I said before, I would fully expect the market to come back down here and actually, and keep in mind, this is a V bottom, right? So really at some point, this should be tested. Now, maybe the market says, fuck it, I'm just taking off and I'm heading higher. Okay. Well, going forward over time, I would definitely make reference to this as a level that we should keep an eye on. And, you guys have heard me talk about stop runs, liquidity hunts, right? Can everybody see how there's a huge ass liquidity pool sitting right down here? So they could just dip it down. Nice solid candle body. Close, ran after all of that liquidity, all the stop loss orders, and then they take it up. You want a nice simple trade entry. You see that this gap is sitting here. I'm going to work my stop just below these orders. I'm going to buy on this W here. And if we do crap out and lose these lows, then I want to get the hell out of there because this is a V bottom and I don't know where the hell the bottom is. All right. Number 20. In this chart, not the cleanest, easy example and chosen for that reason. Okay, cool. I try to identify breakaway. I think that's breakaway. Measuring and exhaustion gaps and apply the measurement projection to two alternatives. I also tag an island top and resistance levels linked to gaps. Appreciate your feedback. All right, let's see what we got here. I would prefer that you, if you're going to do gap theory, try and do it off of bar charts. So, here, for example, this tail actually was lower than this. So I don't think that the classic gap theory people would even consider that in their analysis. This one looks pretty open. I'm almost looking at this thinking, you know what, that might actually be a breakaway gap there. Again, bar charters, there probably isn't a gap there. And again, same thing here. So I don't know. I don't think I would be using gap theory on this. Too splotchy. Maybe change this. This is Cocoa Futures. Oh, a weekly price chart. Very rarely do we ever see a gap theory on weekly charts. That doesn't happen very often, guys. CC1 exclamation mark. Weekly. I guess that was this move. Yeah, you know what? I think your trading range, if I'm looking at this, I think trading range is in there, and that would be a breakaway gap, leaving this range. So, you have breakaway, then a consolidation. You might consider that a measuring, which really doesn't project that far, does it? All right, so if we go here to here, just really simply there to there, and then above, you might have said that gave you an idea that the market was going to top out up here. But frankly speaking, I don't think I would actually consider this a good gap theory example. It's a tough one. It's not clean. It's not pretty. And I don't really think it's actually a good idea for you to use weekly price charts. I do like the idea that this was a breakaway gap. I don't mind that. Yeah, that's pushing it as a measuring gap. I don't know. I would look at this and I wouldn't say that this isn't a candidate. And also, too, I don't think it's in our best interest to be trying to do this off a weekly price chart. Off the dailies, we might have something here. But yeah, you can see off the dailies, this is actually pretty clean, eh? I don't even see too many gaps here. A little bit of a gap in there, but yeah, maybe. I mean, yeah, maybe. It's a bit of a stretch. I think you're stretching. Simply put, I would suggest that, as I had said before, what I really want you doing is sort of asking yourself, okay, yeah, this market gapped. Come on, you. Based on the fact that I've drawn my fibs and I have my reload zone set, I'm going to be looking for a top up in here anyway. And horizontal support and resistance, market structure failure level. It should make total sense why I should be looking for failure up in here anyway. So thank you, James. If you're looking at this chart and you're kind of like, okay, how can I see price work its way up into this reload zone? Do the gaps give me any guidance to sort of come up with levels? I mean, as I said before, I don't really have much here to work with. So I don't necessarily think that gap theory would help us too much. But at the same time, too, I suppose, if you were looking at the weekly chart and you happen to see this, very cute little unfinished business here, I guess we'll like that. I would have liked to have seen like a nice gap for this to be gap theory, a nice little gap, say like right in there, then a nice gap here, maybe as a measuring. And then that would project, something like there to there, and then off of that, there to there, giving us upside objectives. You can go through, and as I said, I included Mr. Gartley's mathematical formula for calculating gap objectives. But no offense, I think the simple answer to this is I just don't see it. I appreciate that you put a lot of hard work and effort. Whoops, not that one. Into your chart construction, wherever the hell it is. Too many charts. There we are. It sure looks to me like you put a lot of effort into this. But me personally, I don't see this setup here. If anything, I kind of think that this is just continuation price action. At the same time, too, if you had said, well, Brian, clearly, on candlesticks, this thing is gapping higher. As I had said before, I know, James, I'm taking too long here. I would have preferred that you had drawn that reload zone up top here and just sort of said, okay, well, I can kind of see gap theory taking us up into that area. And, considering how many holes and how splotchy the chart is, it should make perfect sense why the market is going to stall up here. All right, I got to shut up. We'll keep moving on. Number 21. Identify gaps as reversal levels on daily chart. Appreciate your feedback. Okay, you can see unfinished business there, unfinished business there, unfinished business there. This thing looks like Swiss cheese. What the hell is this? Adidas trading on the Zetra. So, if I see this, I'm just like, oh, Jesus, this thing looks like trouble. Gap area functioned as reversal level. Yeah. We kind of talked about that recently where you could have drawn your fib off of this gap level and just simply hunted like sort of reload zones through here and see if you get any sort of bullish reversals. If you looked at your indicators and you saw divergence developing through here, does it make sense to be hunting for reversals? Okay. If I look at this, that's very difficult for me to justify taking a trade there. It's interesting that last person sort of mentioned that sort of island kind of top when I see this monstrous hole in the charts, and then I see this little thing here. Then I see the failure through here. I wonder whether maybe they were trying to paint an island, but you can see they sort of filled that gap in there with this action. Probably a really good example of, gaps representing resistance. Can everybody see this outside downside key reversal right off of that gapping level? So clearly there's just a massive brick wall of resistance right in there. Gapped again. Think gap and go. Man, this thing's just Swiss cheese. And I wouldn't be surprised if a lot of this gapping action has to do with like weekends and, the markets being extremely volatile, geopolitical events, all that kind of stuff. Here's probably a good example of the gap itself. If you've done reload zones, right, and sort of been hunting, can I get any sort of signs of reversal through a reload zone because the gap level actually held? Do I have any signs of divergence on this move down in here to test this gap level? And then finally, can I get any sort of structure to get me long? So my hunch is number one, little bit illiquid. It's interesting how this is a daily price chart. When I see charts that look like this off the daily, what it means to me is there's a lot of unfinished business, like right here. If I was actually looking for a top, there's a big M top, and I did a 50% rule back down against these lows. My hunch is 50% is probably somewhere in here. And, if the stock market shits the bed or whatever, could you get a nasty dump down against these lows to fill in this monstrous gap here? I think absolutely. It also would be really cool too if you actually change this to a bar chart and see if you can actually see gap theory at work here. You might actually see that like this kind of looks like a breakaway gap. I don't know whether we could use that as a measuring. Maybe that's exhaustion. And, basically, and that's not the best looking example. Maybe you even have to use this as measuring. But we filled that in, so that all is negated. We now have some more gaps in here. This gap is still open, so maybe we could use that as a measuring. So there to there, painting an upside objective somewhere up in there. All right, so I hope that helps. I mean, it is a messy looking chart. And frankly speaking, like I want to see W's, right? That's what I want to see to be a buyer. So the fact that I'm seeing this M worries me. M's worry me. W's, okay. Coming against key support, okay, looking good. You want to do RLZs. Might be interesting if there's some gaps off lower time frame down in here. Big run up, pull back against the original W's. New W's coming in, but now we're getting into horrible trade location. So really, a guy like me, I just got to leave this thing alone. Okay, let's keep moving forward. Interesting chart. I think I would agree with you. Gaps like to be filled, and really good example of market coming back in and filling them in. If they can turn without filling them in, just make damn sure you're hunting divergences and structure. But once we get up into this area on the price chart, looking at this entire range, I really couldn't trade this. I just have to leave it alone. Okay, next one. Tried to use a gap as supporting reason for AB equals CD. Makes sense? Well, let's see what you got here. Try to use a gap, AB. Yeah, that makes perfect sense. Totally. Wicks and tails like to be eaten. Yeah, solid. Excellent. Yep. Hey, actually, a question that's nice and easy for me to answer. Yeah, love it. Love it. Love it, love it, love it. Now, ideally, what I'd love to see is divergence. Ideally, I'd love to see that this was a higher time frame trade location. You could do reload zones, which probably also paints a nice RLZ in this area. I'd love to see the market come down, fill in the gap, then put in a nice polite W, and you got yourself, what would be really cool is to do a trend line off of these peaks. Then the market comes down, fills in the gaps, put in a nice W, and breaks out of the trend line, and then you got yourself one hell of a trade. But on balance, what I see is you're heading in a good direction. But this also really speaks to the fact that we can't justify taking a trade off of just one reason. So when we do come in down into this area, go look at the indicators. Are they in divergence? Are they, structurally turning? And then finally, do we have some sort of price structure to work with to frame risk? Just blindly entering an order at that level, that might be asking for trouble. Okay, in gap theory, how do you define the breakaway gap? How do you define the measuring gap? What if there are many to choose from? Um, well, see here, yeah, that's a tough one. I do like this, like this gapping move here. Notice that the market pulled back and it was still basically in the trading range. And this one here, market gaps higher and then literally comes right back down to it. What I want to see now, yeah, remember we had talked about this, Dennison. Was this a clean breakaway gap? Yeah, it's debatable. I suppose, yeah, I mean, I don't like this as a breakaway gap because literally we were down at the bottom end of the range and all they did was just bring it back to the middle of the range. I like how they broke it out here and then they went and busted this high, which actually formed a big ass W. And I also like the fact that they brought the market back down and didn't fill the gap in. Could this be our breakaway gap? Yeah, I talked about it before. It could be. What's interesting about this, of course, like I said just a moment ago, is this actually is now all filled in. All of these gaps now have been negated. Now we start the process all over again about hunting new trend continuation formations. And I might make the argument, same thing here, that this thing basically came in, filled in the exhaustion, filled in the measuring, and is in the process of trying to fill in this breakaway here. Yeah, I like this. This one, I'm going to call this sort of a trading is more of an art form than a science. It worked really well in that these levels corresponded with higher time frame objectives, and the euphoria around price action up here was absolutely perfect with sort of that gap theory kind of thinking, which sort of validated in my eyes that this was definitely the end of this move. This one here, this was an extremely short-term, very powerful move. And same thing, up at these levels, I started to see the same kind of conversations with down here. Breakaway gap breaks away from the previous range. Ideally, that's what I'd like to see. So I don't know whether I can buy into whether this was a breakaway gap, but if you were like, but Brian, I really like the idea that this is a breakaway gap, then it would be like breakaway, measuring, exhaustion. So breakaway to measuring would imply a target up in here. So that's basically been invalidated. So yeah, the way and they are explained here. Okay, thank you, Alex. And I think actually I included that, didn't I? By all means, take some time and just go through all of these different resources. Yeah, I have it over here. So they go through and explain all the different types of gaps and how you would typify them and define them. Breakaway gap on volume. I like that too. Right? All right. All right. Okay, so good question, hard question. We talked about that. Yeah. So if somebody could just put in those, my suggestion to you is just go read through. Like I've given you about 5 or 6 different references for gaps, and they should all be basically saying the same message. So if you find that one sort of talk or Brian's explanation doesn't quite line up with what you're reading in them, then I can understand that concern. But I think basically the message that we're saying is fairly consistent right across the board. And really the long and short of it here, remember, trading's an art, not a science. And what we really want to do with gap theory is have those levels validate with other tools that we're using. Volume profile, fibs, moving averages, horizontal support and resistance, previous highs and lows, reload zones, extensions. Okay, what is BAT data? So is even TradingView charting real data? Okay, so we actually, if somebody could write in here, I don't know what the time reference was, but we actually talked quite a bit about what BAT's data is. Yeah, here. So whatever, did we make time reference here? So whoever asked this question, I'm just going to simply say, please refer to question 4 above. How's that? That'll make James happy. Please see reply to question 4 above. Awesome. Okay, a doji gap setup. Identify doji gap and the other relevant levels for setting up the trade. TYA for your feedback, Brian. Okay. Okay, the only thing I'm going to say is technically a doji, right? We really don't want to see price come back down into the gap. That's a little dangerous. And is this textbook doji? See this bar right here? This is textbook doji. That's a doji. This isn't the best example of doji because you can clearly see the wick is substantially bigger than the tail. So probably not the best example of doji gap. We would ideally like the wick and tail to be almost exactly equal, and we'd like the body to be really small. So that's not really technically a doji. Ironically enough, this is actually a doji. Very ugly, and really what this is a diamond pattern. But I don't know whether I would necessarily call that a doji or not. And as you can see, I would actually say that this doji gap, number one, are you going to be buying up here? Holy crap, that's pretty risky stuff if you have to risk all the way back down to here. And you can see that the market actually came back down into the gap here. So I wouldn't consider this a valid trade setup. Okay, number 26. Oh, I know who did this. All right, so we have to ask ourselves, is this the most fluid and liquid market out there? I don't know. Not, Emery, I know for certain. We probably shouldn't be doing tether proxies, especially with all the crap around tether right now. I would prefer that you just did like a ETH US dollar chart. A lot of these gaps might have stuff to do with the actual tether instrument, so be careful there, okay, guys? Okay, doji candlesticks trading dojis. Okay, well, thank you, Oscar. I appreciate that. Joshua says one of my Joby gap paper trades for notes. All right. Okay, I like that doji. That's not bad. And ironically enough, you actually have to let this finish, then close out, and you're going to be gunning for at least 2-1. Okay, good. I'm not going to say this is easy. It's not easy. It's just fetching the data. It's easier on Polo. Well, Polo or not, what I'm most concerned with here is the USDT proxy. That's probably what's causing the gaps. And then also Polo, it's been kind of on the outs lately. So, and you're also looking at a 4-hour chart. So be careful there as well. Okay, so then that's not a doji gap setup then, okay, Miguel? If you're, playing the pullback into the reload zone as trade location, okay, great. But as a doji gap setup, no, that's not relevant. As trade location, I mean, you guys have been sitting here me squawk for an hour and a half, right? You've got reload zone, you've got market structure. Does it make sense why the gap is just yet more validation of trade level? And I think that's excellent. The entry was off the C. Oh, right here. Yeah. Well, and we can't call this a confluence, Joshua. I think Joshua's actually typed this word about 5 or 6 times today. I hope you guys are listening to Joshua. That's great. Great stuff. Joshua, you're so fucking good, man. And I love how consistent he is, right? Just keep it simple, keep consistent, guys. Okay, let's keep moving forward. I can see the market often comes back to the gap zone. Okay, yeah, so we talked a little bit about that. Now I'm concerned about the whole tether issue here, as well polo, and as well you're doing 4 hours, right? So there's a whole bunch of issues there. And then, of course, I definitely don't like the idea of you just blindly taking a trade at a gap level. As Joshua suggests, Amory, what's the key word I want you thinking here? Okay, number 27. There are lots of gaps all the way down for BTC. How likely is it for the market to fill? Yeah, I know people don't like when I say this, but I think that there is high confluence, high confluence of confidence in these gaps getting filled. I'm a little concerned, though. Again, you're using a tether instrument, you're looking at Poloniex, and you're looking at 4 hour. I would suggest that we're probably more than likely you want to look at like a daily chart for these kind of levels. Also, too, and I think you did a really good job at this, you noticed that there were gaps left open, but that sort of filled them in. I don't know whether there are that many gaps off the daily chart, but I do know that there are a few gaps. Like there's a gap on the stamp chart that Joshua's been squawking about. I think it's at like 4,300 or something like that. That's been left open for a very, very long time. Okay, well, if that's the case, then what that means to me is that, yeah, there is a very high probability that they will. Okay, so daily and weekly gaps. Thank you, Amory. I appreciate that. Well, I hate to say it. Is there somebody who has threatened to eat his reproductive organs, and I would fully expect him to do so, but he won't, who actually has told the public that his cost of production on Bitcoin is $1,000 a coin? And if we, if US dollar takes off, maybe they, say for one reason or another, what I'm worried about here is this really isn't the best trade location. What I'm worried about here is maybe we do have a nice counter trend rally. Maybe we take the market back up top and everybody's all, yeah, rah, rah, bull, rah, rah, bull. And then keep in mind, guys, are we now in a commodity friendly market or a commodity unfriendly market? I know you guys don't like this. I might make the argument that by, say, 2030, we could very easily find Bitcoin trading back at $1,000, $2,000 a coin and filling in all of these gaps. It might take 5-10 years for that to happen. I could very easily see that happen. At the same time, too, we can also make the argument, just like the gold chart, that there's gaps at $200. And at some point down the road, people are going to be waiting for those gaps to be filled in, and they may just not get filled in. So, there's both sides to there's both sides to this argument. Thank Brian, actually. Okay. All right, let's keep this train moving forward. So I totally appreciate your question, Amory, and the simple answer is I would expect all these gaps to be filled in at some point, even though people don't like that. I know they don't like that answer. But just like the gold example that we talked about earlier, doesn't mean they have to be filled in. And I might be sitting here waiting 20, 30 years from now. I know there's a gap on Bitcoin at $1,000 an ounce, and I'm waiting for it to be filled in. Just like the gold at 200. Definitely possible. All right, number 28. Could you please go over the bullish or bearish gap theory, breakout, measure, exhaustion formula in detail with an example or two of each? Okay, well, that's actually why I went and did this chart up here for you guys. What the hell it is. So I'll just slowly sort of walk you through this. Where did I do that? I thought I added it. Gap theory. Chart. Nope, that's not it. Here we are. Oh yeah, there you go, Alex. Thank you. There we are. So there's many different ways to do this. If you want to be like the absolute most sort of scientific about this, I actually like this tool. And what I would suggest you do, and this is based on Mr. Gartley's work, is just in essence, I think you just need to go and reproduce this chart for yourself. There's not a heck of a lot of reading that you have to do here, but it is extremely verbose. So you're probably going to have to read through it maybe 4 or 5 times to get all of the reference levels. But in essence, this was a market where it gapped higher out of the trading range and didn't look back. It actually gapped higher here, but you notice that we came back and filled in this gap here. Then the market gapped higher again. So the very first thing that I'm going to do is I'm going to throw on the extension tool. And it's just going to simply say, well, if this is a bull flag, bull AB equals CD, where is the market likely to go to? Right? And that's basically what this window is. I then look at the gaps and I'm going to go through this math, right? There is the equation right off of the sheet. If you want to go and copy it, my suggestion, whoever asked this question, is go after we're done this class, go and do this exercise. So you're going to take the low of the bar minus the breakout, right? So this is the low of this measuring bar, 1482, right there, right? The measuring breakout bar minus the base of the actual breakout bar candle, 1316, and that's going to give you $1.66. Now, the way that Gartley likes to do it is he likes to do some math here where he simply says that this should be about 40%. This move up to the measuring gap should be about 40%. In this particular case, you can see it was 45. In this particular case down, you can see it was 44. In this particular case down, you can see it was 39. So you want to use that just simple rule of thumb, 40%. That's fine. 40, somewhere in there, 40, 45%, somewhere in there. But in essence, that's what he's doing when he sort of divides this range by 4 and then multiply it by 10. So in essence, we've taken this distance minus this distance, right, which is $1.66 divided by 4, which comes out to 41.5. And then we're going to multiply that by 10, and then just simply add it to the base, which will give us an ultimate upside objective, 1731. That's what this number is here. Now, what should happen, that's off of this article, Oscar, right? Gartley's Gap Theory Explained Futures magazine article that I put on the school page, right here. Gaps and fibs, range market, Gap Futures magazine article on gap theory. You see that, Oscar? I will copy that and dump it right there. Boink. All right, so we've hit the time limit, but let me just finish off this thought here. So the logic works exactly the opposite in the bear scenario. Now, this is a really good one. There's a breakaway, right? We're leaving the range. Measuring, all right? So if I'm going to come up with a downside target, going to do that 250%. That's what this fib tool is, 250% off of this range. The range, in essence, 250% off of the distance between the breakaway and the measuring. Same sort of logic. Gives you that ultimate downside target. And then you go through the math, right? The base minus the height divided by 4 times 10. So then go and write down all of the numbers exactly like I've done here. And it should give you an ultimate objective. Now, this is a cool one because you'll notice that this measuring gap actually was filled in here. But notice that they went right after they filled in the measuring gap here, they went and gapped the market lower again. In essence, creating a new measuring gap. So really great analogy here of using the bearish gap theory formula from Mr. Gartley after an initial measuring gap was filled, but then a new measuring gap was created. And I also added in on this image, we can actually see that there's a little, breakaway, measuring, and exhaustion gap right in here. You could do this little bearish scenario just off of this move as well. And the big takeaway here is that notice that this gap theory projection, this gap theory projection, and if you want to do a fun assignment, try and figure out the math based off of this formula. This downside objective, they all line up with the reload zone. Not an accident. So what I would strongly suggest you do is go and copy this chart, watch this video back 2 or 3 times, and see if you can replicate this study. We've given you a bullish one to work on, and then 2 bearish ones to work on. And what do you do if the initial measuring gap has been filled, but then they gap the market lower again to come up with downside targets? That's a tough one, and I spent probably a good maybe 3 or 4 hours working on this image because I knew that this question was going to come up. Now, in the course material, I really, remember, guys, I'm the, how do I say this? I'm the path of least resistance, guys. Have you guys ever heard me say that before? I like the path of least resistance. So I want to make it as simple as possible. And we had one gentleman that was like, Brian, I want more firm answer. I want more solid levels, right? So that's why I went through and found this article, found the very scientific answer, right? But remember, Brian's lazy. I want to simple stuff. And so the way that I teach gap theory is just keep it really, really simple. And the equation that I want you to leave this course with is just simply measuring gap minus breakaway gap plus the top of the measuring gap gives us our very simple objective. Now, I know there's people that were like, and there was one gentleman who was like, this is awesome, 250%, this is exactly what I wanted. I can do my fib tool. I have the formulas now. I'm rock and roll solid. Okay, great. So I've gone to the effort to try and furnish them with these tools about very scientific target determination. But me personally, I don't really want to go into that much detail. I just want a quick, nice and easy methodology. Remember, I'm using these gap projection targets. Thanks, Sheila. I appreciate that. As validation of other levels, right? I'm expecting the market to be rallying or selling off into reload zones or into extension levels. So if I get this nice simple tool that can give me an objective into one of those levels, then it's just validation. And this is where Joshua types in, starts with a C. That's how I really want you to use gap theory. But I completely understand that some people are like, Brian, I want more, scientific. Thank you, sir. More scientific answers, right? So I've gone to both extremes here for you in this. So I hope that helps. And frankly speaking, I was very happy with the person who reached out to me and said, Brian, this isn't enough. I want more. Yeah, sure. Why wouldn't it, Alex? Of course it does. Yep, totally applies to crypto. The problem here, though, is that we don't see that gap off in crypto. Okay, 29. I had a look at BTC's bull run and subsequent crash, specifically looking for gaps which could have given us interesting information about the trend. Here's what I concluded. Makes sense? What other observations, Brian? Price gap down 4 days in a row here. Daily chart? Okay, so in essence, think gap and go, think gap theory, think Joby gap. If we're gapping higher and we take out the highs, that's obviously bullish. And then conversely, if we're gapping lower and we take out the lows, that's obviously very bearish. So in essence, what I'm hearing and seeing here is that the gaps did nothing more than just validate the strength of the trend. So you see lots of gaps, market heading down, then clearly that's a very bearish vote. And if you wanted to, on a daily basis, just sort of say, well, based on the most recent price action, do I give this asset a bullish reading or a bearish reading? You can use gaps to help you in that regard. Okay, how to go at gaps on bar charts here, BTC-ME futures. Can you see the huge gaps down they left in the summer were filled not long after, but in the bottom of the range there's a bar gap that I don't know if you consider filled or not. Let's see what we got here. Oh yeah, well, this is what I'm worried about. I've posted the exact same chart. So if we go over to my futures chart, notice here, what does this say? The gap is still partially open. So this concerns me immensely. So you're absolutely right. There is a problem here. We have unresolved business down here. 5 questions to go, and we got 5 minutes, so 1 question per each. Let's see how we do. But anyway, actually, I answered that. So, and if you want a copy of my chart to validate what you're seeing, and, I think I even tweeted this out and stuff, I totally agree with you. And I even said, I'd love to see a nice stab down into here, break everybody's hearts. Oh, Bitcoin sucks. It's going to zero. And then boom, she takes off after that. Totally see that. So if you want to copy this, anybody who's doing the homework doc, if you want to copy that and put that in there, go for it. Here, why don't I just do that now? And we're running out of time, and I can feel my voice is waning here. So, okay, number 31. What is a hidden gap, and should we be hunting them in level 2? I have no idea what a hidden gap is in reference to. You'd have to show me a picture. And should we be hunting them in level 2? I don't know. I mean, if I don't know what it is, you can hunt it all you want, but I'd have to see a picture of it to know what it is you're talking about. What is a clothesline gap? Or is it clothesline? I don't know. I mean, I suppose technically a clothesline won't show gaps because it's a line chart. So maybe that's what they're making reference to. So, if you had, excuse me, if you had a clothesline chart, it won't show the gaps. So maybe a clothesline gap, they'll make reference to the chart where the gap is, because like I said, the clothesline, it just won't show it. 33. I love the ABCD target objectives from gaps, but I'm not sure how to draw them. In a bear scenario, do you draw from top of the gap to bottom of gap, or from top of the gap candle to the bottom of the gapping candle, or something else? Can you give some examples on how to draw these gap ABCDs? And I'd have to see what it is you're looking at, Josh. I'm not quite sure what it is you're talking about here. Remember, guys, I need charts. You gotta show me charts and pictures. This is A, B, C, D. You can clearly see what's happening there. Can you use the gap to help you get in on this trade? I suppose. If anything, the trade that I like is if you did a reload zone off of this gapping action and that level coming in there, probably a 61.8 off of that range there. I suppose you could have worked your bid at this gap. Not bad. Brian, question here was on if bar chart, it would be considered still open. I don't know, guys. I can already start to feel I'm running out of steam, so I think we're going to have to wind it up here. Joshua, maybe if you're in the lounge or something one day, because you're often there quite often, we can throw around some charts. Just bug me later on, okay? All right, last question, and then I'm going to call it a day here because I've been talking for 2 hours straight. If the market is 24/7 and we see daily gap, does it mean that this move happened right on the border of exchange days, like 8 a.m. or 12 p.m.? Well, actually, and I don't know what time locally you are, but for me, the end of the day is like 5 p.m. Pacific time. I think that's when the charts officially shift over into the next day. And so what it literally means is that something significantly happened at that moment. And it does happen. I see it happen all the time. So it really all depends on what your reference is for the end of the day. But 24/7, yeah, it means that something changed right on that daily close. And I see that happen all the time in crypto, all the time. So it's not really like it's out of the answer or out of the question. Happens all the time. Yeah. So Alex is helping out with a reference to how to spot profitable timing signals. So thank you, Alex. Okay, that's 2 hours. Holy crap, I feel talked out. So I think I'm going to leave it at that. I do see that we have a whole bunch of extra questions, but honestly, guys, I've run out of steam here. We'll try and get to these later on. If the TAs can help answer any of these questions, I'd appreciate it, guys. And I might come in here later on today or tomorrow and see if I can just, manually answer some of these questions for you. But you guys really pressed me hard there today on gaps. Hopefully everybody got good information that they can use and incorporate into your trading plans. Other than that, I think I'm about done here. It is the 2-hour mark, and I can feel that my voice is going. So I'm going to leave it at that. You guys have yourselves an excellent rest of your day. All the best, and a big bye for now.